On March 23, Apollo gated a $25 billion fund. People who asked for their money out got 45 cents on the dollar. Then within 10 days, Ares did it, Blackstone did it, Blue Owl did it. 4 of the biggest private credit funds in the world all hit the brakes at the same time. Most of the coverage I saw treated this like a quarterly hiccup. It isn't. There's a specific reason all 4 of them broke in the same window, and once you see it you can't unsee it. Here's what Apollo actually looks like. The fund is $25 billion. In Q1, investors put in redemption requests for 11.2% of the shares. The fund's rule is they only have to pay out 5% per quarter, so they paid the 5 and told the rest to wait. That's where the 45 cents number comes from. You asked for everything, you got about half. Ares had 11.6% requested, same cap, same result. Blackstone's BCRED is the big one. $82 billion, they got 7.9% requested. They could have gated at 5. Instead, they raised their own cap to 7, and then Blackstone employees personally put $400 million of their own money into the fund to cover the rest. Read that again. The people running the fund injected their own cash because the alternative was the headline. That's what they were trying to avoid. April 2nd, Blue Owl capped 2 more funds, $36 billion and $6 billion. Same week, 4 of the biggest private credit vehicles on Earth, all gating within 10 days. That doesn't happen by accident. The reason has nothing to do with defaults. Nobody's missing payments yet. The borrowers are paying on time. What spooked the investors is something they weren't expecting to have to model. Morgan Stanley put out a number back in February that I don't think got enough attention. 26% of all direct lending in the US is sitting on software companies. Not 26% of one fund. 26% of the whole asset class. Between October last year and February this year, software stocks dropped 30%, and it wasn't about earnings. It was about AI agents doing the same work for 10 cents on the dollar. If you're holding the debt of a SaaS company that's about to lose its pricing power, you can't sell it on the open market. It's private. So you do the only thing you can do, which is yank your money out of the fund. Enough people do that at the same time. The fund gates. The funds that gated weren't picked at random. Apollo Debt Solutions is over 12% software. Blue Owl's flagship is heavy SaaS. These were the ones standing closest to the disruption. Then May 6th, the Financial Stability Board put it in writing. AI firms made up 35% of all private credit deals last year. The 5-year average before that was 17. The exposure doubled in 1 year and nobody disclosed it. UBS put a number on the risk that hasn't shown up in the marks yet. Their estimate is 25 to 35% of private credit portfolios are exposed to AI disruption that isn't priced in. So when you look at a BDC's quarterly report and see the NAV looking healthy, what you're actually looking at is an assumption that the underlying software businesses keep charging what they're charging. That assumption is what's cracking. That's the BDC side. The bank side is its own story and it's running on a parallel track. JP Morgan and MUFG put together $38 billion of construction debt for one Oracle data center. Standard infrastructure deal. Line up the financing, syndicate it out, collect the fees, move on. Except, they couldn't move on. 6 months in, they're still trying to distribute it, and some of the tranches are going at a discount, which means the buyers in the secondary market are telling JP Morgan that $38 billion of fully contracted AI infrastructure debt is worth less than face value. That doesn't happen to infrastructure deals. So the banks went looking for another way out. They landed on a thing called an SRT, significant risk transfer. The way an SRT works, the bank keeps the loans on its books but it buys insurance on the riskiest slice. The insurance is sold by outside players, mostly insurance companies, pension funds and other private credit firms. They get paid a premium. If anything goes wrong, they eat the first loss. The bank gets to treat the loans like they sold them for capital purposes. Morgan Stanley is in early talks on an SRT for its AI loan book. TD Bank is structuring a $1 billion SRT with what's called a forward flow provision, which means they can keep adding new loans to it as they originate them. That last part tells you everything. They expect to keep originating AI debt that they immediately want to insure against. They're not buying protection on a one-off. They're building a pipeline. And the people on the other side of those SRTs aren't buying diversified pools. AI data center finance doesn't work that way. They're taking direct exposure to 3 or 4 specific borrowers. Oracle, CoreWeave, the shell companies OpenAI is using to build out compute. One of those names hits trouble, the whole tranche moves at once. Bank of America put out their Q2 forecast for the same three BDCs we started with: Apollo at 15% redemption requests, Ares at 14, BCRED at 12. All three triple the historical pace, all three above the cap. Q2 ends the same way Q1 did, except this time investors who weren't planning to redeem are going to want to be first in line because they saw what happened to the slowpokes. Morgan Stanley's default forecast for direct lending is 8%, the historical average is 2 to 2.5. The smaller funds, the ones below the mega caps, are already at 10.9 right now, not a forecast, where they are today. Now, the scale of what's being funded, because this is where it gets absurd. Morgan Stanley moved their 2026 hyperscaler capex number up to $800 billion. That's almost double last year, triple 2024. They're projecting $1.1 trillion in 2027. For context, global oil and gas exploration capex last year was about $580 billion. AI is going to eat more capital than the planet's hydrocarbon industry inside 18 months. That money has to come from somewhere, and right now it's coming from the bond market. U.S. investment-grade issuance is on track for $2.25 trillion this year. Record, up 25% year over year. Tech alone is 18% of supply, double what it was last year. Highest tech concentration ever recorded. Here's where it loops back to regular people. This is the part I think most viewers don't realize. Over the last 7 years, the big private equity firms quietly bought or partnered with life insurance and annuity companies. Apollo bought Athene, KKR bought Global Atlantic, Brookfield bought American Equity. None of it made big headlines. It changed how retirement money moves through the system. What an insurance company does with your premiums is hold them as reserves and invest them. Regulation says they have to. Historically, that money went into boring investment-grade bonds. After the PE acquisitions, the reserves got routed somewhere else. They started going into private credit funds owned by the same parent company. Those funds then lent the money to PE-owned middle-market software companies, mostly between 2022 and 2024, which is exactly when SaaS valuations peaked. So now follow the money from your perspective. You bought an annuity. The premiums went into the insurance company's reserves. The reserves got allocated to the private credit fund next door. The fund used your money to lend to a software business at the top of the market. That software business is now competing against AI agents that do the same job for 10% of the cost. And the whole structure is set up so you have no way to know what your money is sitting on. That's the part the FSB letter actually flagged. Not the size of the loans, not the default rate, the opacity. The fact that the person taking the ultimate risk, which is the retiree or the policyholder or the pension contributor, has no information about what they're funding. The total private credit market is $3 trillion right now. It was $800 billion in 2018. It has never been through a credit cycle. Everybody wants to compare this to 2008. That's not the right comparison. The leverage isn't there. The bank capital ratios are way higher than they were in 2007. The transmission mechanisms are different. The right comparison is the savings and loan crisis. A capital-hungry sector got financed too fast through structures that hid the concentration. When the underlying assumption broke, the financing cracked first, and the real economy followed. Two things I'm watching from here. One is the spread on those SRT tranches relative to non-AI infrastructure debt. Right now they're trading basically on top of each other. When that gap opens up, that's the market telling you it's pricing in trouble before the news does. Two is when banks start breaking out AI data center exposure as its own line item in their quarterly disclosures. Right now it's buried inside generic infrastructure or tech lending. Banks don't volunteer that level of detail. They start doing it when regulators or auditors make them. And that always happens before any actual write-down shows up.